We are repeatedly told a very simple story about how money works in America. The Federal Reserve controls your interest rates. When they want to slow the economy down, they raise rates. When they want to speed it up, they lower them. Look at early 2026. The bottom line is the Fed funds rate. It didn't move. 0 rate hikes. Yet that breaking line climbing rapidly represents the average 30-year mortgage. In weeks, it shot up 47 basis points. That mathematical jump had immediate consequences. Mortgage applications dropped 10.5% in a single week. Refinancing effectively froze. The cost of carrying a new home loan suddenly jumped by hundreds of dollars a month. When the Fed effectively loses its grip on the steering wheel, the largest financial decisions of a citizen's life, from buying a home to refinancing a loan, are left at the mercy of global debt markets that Washington no longer controls. To find those forces, you have to look at the baseline metric banks actually use to price your home loan. They don't use the Fed's rate. They tether your mortgage directly to the yield on long-term U.S. Treasury bonds. A small number of foreign governments hold massive piles of that U.S. debt. When one of those nations faces a sudden geopolitical conflict or an economic shock, they suddenly need cash. The fastest way to get billions of dollars in hours is to dump enormous amounts of U.S. Treasuries onto the open market. The bond market operates on a strict seesaw. When massive bond supply hits, prices drop. The yield percentage is mathematically forced to rise. American banks use that yield as their floor. When it climbs, your 30-year mortgage rate is dragged right along with it. A sudden liquidity panic in the Middle East or Asia quietly extracts tens of thousands of dollars from a single American family over the life of their loan. The Federal Reserve knows exactly how exposed the domestic housing market is to foreign sell-offs. To counter it, they quietly constructed a structural defense mechanism out of public view. During the 2020 pandemic, the Fed created a temporary emergency tool called the FEMA Repo Facility. It was meant to last 6 months. Instead, in July 2021, the Fed quietly made it a permanent standing facility with 0 public debate. This flowchart tracks how the mechanism actually operates. It works like a pawn shop for sovereign nations. Rather than dumping treasuries onto the open market and crashing the price, a foreign central bank can bring those bonds directly to the Fed, hand them over as collateral, and walk away with dollars. By keeping that debt off the open market, the Fed prevents treasury yields from spiking. That isolated private trade is the singular barrier stopping a foreign dollar shortage from instantly inflating your mortgage rate. But when a central bank has to rely on an emergency last resort tool as a permanent daily fixture, the primary system is no longer functioning on its own. That hidden backstop is currently buckling. The stable, predictable foreign buyers who traditionally absorbed American debt are stepping away. For decades, Japanese institutions were the most reliable buyers of U.S. Treasuries. Because their own interest rates were near 0, they borrowed yen for nothing and bought higher-yielding American debt. But in 2025, the Bank of Japan finally raised its policy rate. The free money ended, and massive amounts of reliable Japanese capital began flowing back home. The buyers replacing those steady central banks are private foreign investors, hedge funds, and leveraged asset managers. They do not hold debt for geopolitical stability. Their entire business model revolves around fleeing the market the second conditions sour. That thinning cushion overseas is colliding with a massive compounding crisis inside America's own borders. Look at the sheer volume of debt on this timeline. This tracks commercial real estate loans. Unlike a home mortgage, these loans don't slowly pay down. They come due in full. In 2025 and 2026, over $1.5 trillion of this debt reached the end of its term, acting as a ticking time bomb for local lenders. Many of these loans are tied to massive office buildings that emptied out during the pandemic and never recovered. The buildings are worth vastly less than the debt attached to them. Instead of taking the loss, regional banks use a tactic called extend and pretend. They simply push the loan deadlines forward and hope the math magically improves. While those banks sit on billions in quietly rotting debt, they become increasingly cautious. They choke off local credit. Small businesses can't get loans to expand, and first-time homebuyers get squeezed entirely out of the market. The Federal Reserve is caught in a vice. They are trying to defend a record-high national debt from a retreating, volatile global market. while simultaneously trying to prop up a domestic banking sector choking on its own commercial loans. Since 2008, the total financial commitment the Federal Reserve has deployed to rescue the system through various shadow backstops tops $29 trillion. Not a single cent of that vast fortune built a highway, funded a school, or generated real economic productivity. It was entirely spent on buying time, masking the stress, and preventing the financial plumbing from seizing up. The cost of buying that time is the death of honest pricing. When the world's largest financial players know the Fed will always step in to absorb their worst mistakes, the market loses the ability to calculate true risk. Healthy capitalism requires the threat of failure to regulate behavior. Replacing that threat with a standing central bank rescue removes the incentive for caution, leaving a fragile, subsidized system in its place. American financial independence is a relic of a bygone era. There was a time when the global economy absorbed U.S. debt eagerly and naturally. Today, the world requires a permanent, multi-trillion-dollar safety net just to hold American bonds without triggering a panic. The value of your home, your car loan, and your retirement are permanently chained to the health of this brittle global architecture. As the system reaches the limits of its ability to absorb these hidden losses, the existing backstops are tuned to keep the global machinery moving, not to shield the average family from the resulting economic squeeze.